Hi, everybody, and welcome back to yet another cracking installment of the Map Round Show. This is the Private Placement Perspective series where we're connecting you to venture capital firms, investors, and just people who know a hell of a lot more about the space than I do. So with me on the line is the managing partner of an amazing firm called Synapse Partners out in California. His name is none other than Evangelos Simoudis. Evangelos, welcome to the show.
Thank you very much. Good to be here.
The privilege is all mine, man. So we've had a few minutes just to check in and kind of connect, and I'm very curious to learn more around what you guys are doing, which sounds very different. But for our viewers around the world, Evangelos, who haven't heard about Synapse Partners and what you're doing in the venture capital space, curious to for you to paint a picture, really, of your firm. Give us the elevator pitch. What are you guys up to? What's the size of your fund? How many funds have you raised? Anything you want to share with us around Synapse Partners? Kick us off.
Great. So first of all, I'm really happy to be here. Happy to have this conversation with you and your audience. So Synapse is an early stage venture capital firm based out in the Bay Area in California. We invest exclusively in early stage startups that develop enterprise software AI applications. And we bring together both our deep technical knowledge of AI, so we're a specialist fund from this perspective, and our deep relations with corporations that do important work in AI and utilize AI in their operations.
Okay, so how did you get your start in the world of investing?
So I've been an investor, personally, I've been an investor for about 23 years now. And I came to become a venture investor after selling my second startup. I've been working in AI since 1982. So a lot of my both entrepreneurial work, corporate work, and then the subsequent investment work have been around enterprise software and data/AI. So these are kind of like the consistent themes that have governed my career.
Very interesting. It seems to me like AI is all the buzz. It's just like, everyone has some kind of AI extension. I don't know whether it's proprietary or not, or whether it's just an integration with ChatGPT now. But walk us through, like, how liquid is the space at the moment? You guys must be living the dream.
So, first of all, I should say, since its inception in the 50s, AI has gone through numerous springs and winters. And today we are in another spring, and we'll see how quickly the inevitable winter will arrive. The fact is that in being in the space, and we've been in this space now for our firm was established 7 years ago. So from the beginning, all we've been doing is AI. So it's, in one sense, it's very gratifying to be in a space that is hot. The downside is that we get to see a lot of pretenders who claim to be doing something important in AI, but they're not. They're trying to capitalize on all the hoopla, let's call it, that exists about the space today.
Yeah, it's. I think there's a big difference between an AI unicorn and an AI donkey. And I suppose your challenge is trying to figure out which one is which.
You said it right.
Yeah.
And we have, in our case, we benefit both from our firm's, as I said, deep expertise in the area. From the advisory board, we have a very illustrious advisory board with a few people that have done quite significant work in AI. And then we have as I said before, we have the separate group of corporations that work with us. And through that work, we are able to both see what are important problems that they need, that the corporation needs solved, how we can contribute to the solution of those problems, and what may be white spaces that startups can occupy and in this respect become successful. So when my partner and I started the firm, we felt that this combination of capabilities and competencies is quite unique even in the area of venture capital. And I think we were correct in our assessment because of the success that we've seen thus far.
Mm. So, could you fill our viewers in from around the world, Evangelos, on the types of startups you looked up? Obviously, we've landed the AI requirement there, but are these pre-revenue? Are they revenue generating? How many investments have you made to date? Walk us through what that looks like.
We, as I said before, we look at early stage startups, and to us, early stage startups could be pre-revenue with the beginning of a product, all the way to the beginning of the traction, let's call it, right, where you've had your couple of design partners, and now you're starting to move with some repeatability to getting your first 10 customers. We like that because we like that area, we like that space, that stage of investment, because we believe that while there is quite a high level of mortality, as you can expect in these early stage startups, we believe that also you can get a lot of value as a startup is starting to grow. And the investments that we make tend to be from a few $100,000 on up. We've made 30 investments to date in the 7-year tenure that we've had in the firm, and half of them we've had good exits. The portfolio right now is about 15 companies, 15 active companies.
And Evangelos, just so we all follow along, where are you guys in your fund cycle? Like what is the age of your current fund?
We have because I've been involved in AI for such a long time, one of the selection criteria that I had for LPs was to identify individuals institutions who understand that developing AI applications is a long-term process. It's not something, in other words, that within 6 months you have success. Building whether it is the neural networks that drive these applications or some other representation, and then testing it and making sure that the results are what the customer expects, takes longer than in a typical enterprise software application. So, with that in mind, we created a greenfield fund. So we do not have, for the time being at least, we have not had cycles where we say we need to finish investing in 5 years and then harvest in the following 5. Instead, whenever we find an opportunity, we invest. Sometimes we reinvest funds that we gain from exits. Other times we bring some of our corporates to co-invest with us. So we have a variety of schemes that we have used that we have found them to be effective in this.
Yeah, I wouldn't use the word schemes.
Well, plans.
Plans. I was being
well-established structures that we have tested and have worked out well.
Mm-hmm. And it seems that way and it's an interesting point of departure because what makes you guys unique, would you say? Because you're not approaching this thesis like a typical fund might or a venture capital firm might. One, you're niching into AI. 2, you have this green fund, so to speak. You have also these strategic. So you're sounding quite unique. So what would you say is your point of difference, and what would you like the world to know about you guys?
First of all, is the deep expertise in AI. And the deep expertise is coming from the principals, the knowledge that the principals have. And I should say that within our firm, we also have software engineers and data scientists. So we practice what we invest in, okay? The second thing is our AI advisory board, which consists of both entrepreneurs and AI luminaries, let's call them. And the third is that these interactions with corporations have been invaluable. And I would say most good VC firms have some type of an advisory board from the space where they invest, whether it is a consumer space or the enterprise space. And what is different with us is that we don't have just a lightweight interaction with these corporations. We actually spend a lot of time with them, sometimes a couple of days a month with each one. So it's a significant investment on our firm side to spend this time with corporations. And in the process of that, we get to understand problems that they have in significant depth. And through that understanding, we then apply our own expertise, our firm's expertise, to decide, is this a problem that a startup can solve, or is this a problem that is better addressed by a large solutions provider, an Accenture or an IBM or an SAP, right? Companies like that. And that has helped us in better filtering which companies we want to back, which startups, in other words, we want to back, and which startups we don't want to work with, not because they may not have the right value proposition, but because of what we know from the industries and the corporations that we work with. We know that what they're proposing may not work as easily as some other investment opportunities that we have.
It's very interesting. And I want to double click on something you touched on. You said that AI, given the fact that you've been in the space for so many years, you said that, you have these summers and then you have these winters, and we're kind of, having an amazing time at the moment. And obviously this affects a lot of things in terms of like the volume of deal flow that you need to look at potentially, or that you get pitched. I mean, even now I'm thinking I want to connect you to someone in my network who's also looking to raise Dynam, also in the AI space, and then there's how many others, and so then also that you also mentioned that you select LPs based on, again, the context of what you guys do, right? And so I'm very curious to get your perspective on what role do these cycles have, on your ability to not only choose the right types of startups to invest in, but also from an LP engagement strategy perspective. It's kind of like you're in the summer now, like LPs must be like, oh yeah, it's AI, great. It's a bit of you get more traction there than, let's just say, if you were doing, something in hardcore medical R&D.
Well, look, LPs first and foremost, no matter how patient they are, they're looking for exits. They're looking for exits that provide good returns for the money they invest. If many years ago, I had met a corporate venture capital partnership, and they said, we have taught our LPs how we can take $100 million and convert it to $2 million. So LPs are not looking for that, right? They're looking how you can take 100 million and make it 500, right? Or some multiple that is. So LPs are looking for that. The other thing they're looking at is what is the cohesion of the investment team, right? Because at the end, you may have a group that help you, but it's the people who write the check, who have their name on their check, who say, okay, I'm representing Synapse partners and I'm investing X amount of money in this company. And what is the track record and what value they bring to the company, right? Because sometimes, and all of us have felt this in the investment space, you put money to work, you make an investment, and you have a great exit, and you don't really even know how that success came. You get lucky in a sense, right? But most of the times, venture capital is very hard work. And LPs want to understand, what are you providing to each of your portfolio companies? How are you helping with your connections, with your knowledge, with your experience? How are you making that team, that startup team, get better and and increase the probability that they will have a very good exit while reducing the risk, right? Whatever risk they're facing, market risk, team risk, technology risk, business model risk. Now, there are a bunch of different types of risk that we consider both when we make investment, but also how our own contributions help the reduction of these types of risk.
That's a very interesting point, because you would think, I suppose if I was putting my LP hat on for a moment, I would say, I would probably look at your thesis, why do you guys matter? What are you trying to actually do? Kind of like Peter Thiel's, what's that fund that he's created now? Anyway,
yeah.
But he wrote that whole manifesto on it, right?
Yeah.
Similar sort of idea. And I'm very interested on double clicking on what you said there around like LPs, hey, and going over and above that, well, how are you actually going to help these guys over and above just putting my money into these 10 portfolio companies? Do you find that is an exception because of the context that Synapse Partners lives in and breathes in every single day? Or do you feel, in your experience being in the space for so many years, that is something that LPs are looking for more and more so that they can get that, that return that you mentioned?
Give you a couple of points here. So the boxer Mike Tyson had said, everybody has a strategy as they get into the ring. And then I punch them and the strategy goes away, right? So it's very easy, with the same token, it's very easy to say, I have an investment thesis and this and that and the other, until you get though into the market and you invest, and more importantly, you try to help the company post-investment. I'm at an age now that I also mentor a lot of young VCs, young partners, and I say to them all the time that it is very easy to deploy capital. It is very difficult to generate returns, positive returns. And this is something that young investors don't always understand, because they think that the role of the VC is to come in, to find a few startups, write a few checks, and then you stay back and automatically you have the right exit, right? And that's not the case. I mean, the point is that it's very hard work. And in fact, in the periods that we are going through right now, where the financial markets have retrenched, we don't have many exits, we don't have IPOs, the large corporations that typically acquire startups are not looking to acquire because of their own financial issues. So now it's the time, it's periods like this where the hard work that the VC is expected to do really shows and separates, if you will, the men from the boys, right? And that's something that we always try to emphasize, both to our own people, but also to the co-investment partners that we have with. I mean, to us, it's very important to know who we co-invest with in every one of these companies that are in our portfolio, and both in terms of what experience the co-investor has, but more importantly, how willing they are to roll up their sleeves and really help that early stage, because we're always dealing with early stage companies to begin with, how they're going to help that company beyond sitting on the board or writing a check.
Yeah, and on that bombshell, we're going to take a quick break. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before, and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Evangelos, I've been looking at your portfolio. You've got an amazing portfolio of companies here in the AI space. And so I guess I have to ask you now, like, what factors do you consider when making an investment? Or maybe I should better rephrase that. When do you say no? Like, when does it go wrong for you? Because as we touched on, your space in a summer right now, you get a lot of throughput of potential deal flow, I should say. And you have to say no, I'd say more than, you would in a winter season. So where does it go wrong in your experience when a startup comes to you and says, listen, I want $2 million, to build this platform or whatever the case is? Is there a commonality or a common mistake that you see founders coming to you for capital and it's like, no, we're not going to do this? Where does it go wrong?
So typically what we look at is what is the problem that the startup is trying to solve, and what is the team with which it is starting off to address this problem. And we would like to, because what we find a lot of times is startups may try to solve a problem that either is not there or was never there or will never be there. And this is where, by the way, our corporate relations play a great role, great help in helping us formulate an opinion about this. The second thing, though, and even more important, is to make sure that we're starting from the right team. And the right team needs to have members with complementary skills, members that have each other's back, as they say, and members who will set the right culture so that you can attract the right people into the company, right? Because, we will see, let's say, a 3-person founding team, that the problem they're trying to solve, no matter how capable these 3 people it's not going to be solved by just these 3 people. They will need to attract another set of great people around them, right? So we're trying to determine what is the likely culture what is the likely fabric that this initial team is likely to put together in order to be able to attract the right individuals who will solve that problem that they're setting off to solve. And there are times that this is extremely difficult because, like we had in recent times, it was very difficult to hire people, right? Every good person will go and work for Google or for Meta or for Amazon, you name it. So it was very, and there were so many startups that were looking for the same type of people. Now it's becoming a little easier, but just because you have the number of people, it doesn't mean that you have the right people. So again, we're looking for this combination of solving the right problem with the right team. And every time that we have ignored, I will say this both personally and for the people that I've worked with and work with, every time that we ignore one of these 2 things, we had a failure.
Oh my gosh, because that was actually my next question. Like, what has been your greatest success and failure in this space, and what makes the difference? So that would be the difference.
For me personally, that is the difference, right? I mean, every time that either I choose to ignore the weaknesses of a team and say, we can fill them out. We can find somebody to make up for that problem that we're seeing. Every time I was wrong. And it is because of the special role that founders play in a startup. It's okay to replace the 100th engineer with somebody else, right? Because by then the culture has been set. The company has a particular trajectory. But going from employee number 2, let's call it, to employee number 3, that's a really difficult transition. You better find the right employee number 3, number 4, number 5. I always claim that the first 10, 15 employees are the key to every company's success, starting with the founding team. right? If you don't have the right employees at that level, the probability of failure, I mean, you may still get lucky, and we've got examples like that as well, but in all of our careers, right? But if you were to play it down the line, you most likely you'll have a failure.
Evangelos, what's one piece of advice, given all your experience, that you'd like to give a founder who's listening to us on the podcast or maybe watching this on YouTube and is looking to raise, right? Let's just, for argument's sake, they're in the AI space. What is one piece of advice you'd like to give that founder about raising money today?
So, if you will permit me, I will give 3 pieces of advice. The first one is make sure that you have the right team members around you as a founding team when you're setting off to say, this is my team, and I'm going to raise money around this team. Okay, that's point number 1. Point number 2 is make sure that you understand what the VC that you are approaching, the firm that you are approaching for funding, has a relevant interest to what you're trying to do and relevant experience. You will not believe how many investor presentations and investment requests we get on a daily basis from people who haven't even visited our website where we try to say pretty clearly what we are investing in, what is our philosophy, right? And they will approach the firm with all sorts of irrelevant to the firm investment opportunities, right? So understand what that VC is doing. Don't waste your time and the other person's and the investor's time. Okay. And the third one is I think in the world that we live, there are a lot of problems that need to be solved, right? For the enterprise, for the consumer, or whatever. Spend the time to find the right problem and make sure that this is a problem that can be solved by a startup. I mean, to me, this is in all these years. I mean, I've been an entrepreneur for several years. I've been a corporate executive, and then for a couple of decades now, I've been an investor. Not every problem can be solved by a startup. Sometimes the corporations will not accept a startup to provide a solution, or they will be very difficult to make that because they are very risk averse, or they are regulated, or whatever the case may be, right? But make sure you understand that if you're solving a problem, it's the right problem, and your solution can be accepted by at least some initial customers. Over time, it may be accepted by a broad swath of the industry, but the first few customers are always the hardest. And as a startup, you already have a lot of things going against you, from the funding, from all. Make sure that you make those right choices because they really pay off.
Can we double click on that? Because I'm curious about that. Because I think you're right. I think the prevailing idea is, that every problem in the world can be solved by a startup, can't it? So are you saying then that it's about the problem is either too far in the future? Like if you think about a startup who's trying to, maybe Elon Musk, for instance, everyone thought he was crazy, when SpaceX came around or whatever. It's like there's this idea of like, well, no, it's too hard. The technology is not mature enough. There's no customers for this problem. And. Are those some examples that sum up what you mean? And if not, could you provide more clarity on that?
Yeah. Look, most entrepreneurs that we come to contact with, they're looking to raise their first couple of $1 million. They do not have 50 million or 100 million to put into the venture they want to build. You mentioned Tesla, Musk put a lot of his own money, which he had made under PayPal, into that venture. That's a whole different ballgame. Okay. I'm talking about the engineer who, said, maybe works for a large company, maybe works for a small company and says, I have this idea, I want to create my own company, right? I want to build my own team. I want to put my own shingle up, as they say, right? That person, that team has a lot of things going against it. And first of all, is raising that capital. And especially in times like we have entered over the past, 8 to 12 months, raising that initial capital is getting harder, right? Investors are becoming more risk averse. They will not give you the first $500,000 check or first $1 million check for something that is just an idea. So it's important to have that thought process that I articulated a minute ago. Again, everybody has different situations. I don't think that we have many Elon Musks around who can both have their own resources and the strong ideas and can bring the people, the right teams around them. That's my experience, at least.
Yeah, no, well, this is it, right? So let's just say you meet a founder or a founding team, and they're the right team, that they say the right things, they've got the right problem to solve, and you like what they have to say, and you want to back these guys. Let's say that they're asking you to cut a check for $2 million, say, or 1 or 1.5 or what have you. Is there a preferred capital structure that you use or prefer to use on a ticket or a check size like that? Is it a safe note, convertible note, and when does it start to change for you?
So we've done safes and we've done convertible notes. We don't really like them, to be honest with you. We prefer priced rounds. Like every investor, early stage, you don't want to be, you want to be as egalitarian as possible, right? You don't want to put too many complications in a term sheet when you do that early round, but we do prefer price rounds to convertible notes. And safe is you can call it a variation of a convertible note. But we prefer price rounds without a lot of bells and whistles, though. We like clean, middle of the road term sheets, whether we offer them or another firm offers them and we participate in it. We think in the early stage, too much complexity doesn't lead to better returns for the investor.
Mm-hmm. So, Evangelos, for now, I'm curious because it depends on which type of VC you speak to. But I was chatting to Nick just before I spoke to you, and he prefers convertible. And you're saying no, you prefer price. He specifically said we don't like priced, but I mean it's different types of. He said we prefer priced only if you're doing Series A or later. But is there a reason that you prefer priced rounds versus convertibles? Say.
Yeah, I would say that it spells out a lot. I mean, I believe that it gives equal weight to both the investor and the entrepreneur, but also makes things a lot cleaner, right? In terms of what are your rights under the financing round. I think it creates the right discipline for the entrepreneur. I think convertibles and safes were obviously more entrepreneur friendly, and at a time where there was so much competition for giving money to entrepreneurs as opposed to expecting much in return, convertibles and safes became the preferred way of making that an early investment, right? Because again, we're talking about early investments. And as I said, we've done them. It's not that we have not done them. You ask me what we prefer, but we prefer because the price round, because as I said, it makes things very clean. It provides a good understanding of what the baseline for the valuation of the company. It provides a good foundation for the next investors, the next set of investors that will come in on how they should view the company. And if there is value that has been created, hopefully the team has created a lot of value, then you get the step up. And if no value has been created or little value has been created, then you get the step down. And as I said, I think to me, this is this is the right way. It creates the right balance for both investor and entrepreneur.
Got it. So, Evangelos, you mentioned exits earlier in the show. So curious to understand from you on how you approach exits. So let's say you have a priced round, you own 20% of some company, and they grow. Thankfully, they solve the right problem, etc. And then a strategic partner comes along and goes, listen, we want to take you guys off the market. We like what you're doing, or what have you, or maybe we want to take you to an IPO, etc. How do you approach evaluating exits? Like when do you say now is the time for us? Do you always take a board seat, or do you not? Or you know what I mean? Like, and then would you potentially offload your shares on the secondary market for whatever reason? There's obviously different approaches there. So what's your approach around exits? Like, how do you decide?
So this is a very complex question, I should say. So let me give it a shot here. The condition of the company plays a big role. So we've had exits, and I should say, because we invest in companies that provide enterprise software solutions for the enterprise, most of the exits that we are dealing with tend to be acquisitions as opposed to being IPOs. This is the traditional path for enterprise software companies in the 30-some years that I've been working with them, both as an entrepreneur, as I said, and as an investor, for a middle-of-the-road type of outcome. So in the case of when a potential acquirer comes and says, I'd like to acquire your XYZ portfolio company, like any good investor, you want to look at both. What is the state of the company? What is the prospects given the state of the company? Sometimes we've dealt with situations where the right acquirer comes at a point where you have already reached the limits of the current team that you have. And you say, okay, if I don't accept that acquisition, it will take me now a long time to revamp the team, bring a more experienced management team with the right investments and all of that. And so you're saying, okay, maybe it's good enough to let the acquisition go through right now. There are other cases where the capital requirements become a driver for the acquisition. So you're saying that, okay, when I first invested in this company, I had an idea that in order to capture that market, it will require, let's say, a total investment of $70 million. Whereas now that I'm in the market, I realize that it's more like $150 million investment, right? So you're saying, well, maybe that type of investment better done under the umbrella of a larger company, larger corporation, as opposed to as a series of venture investments. And then other times, corporations come and make you an offer that you cannot refuse, right? It doesn't even take a lot of analysis to say, we'll take it, right? And we'll have but again, all of this is not a decision that we make just ourselves as investors. This is all a decision that, under the right circumstances, has to involve the management team, starting with the founding team, and in collaboration with the board, which many times includes both investors and non-investors. But if it's early stage, typically it will be just founders, management team, and investors. But there are, again, as I said, it's not a simple question. It's a very good question. It's not a simple question. And it's not even the circumstances typically drive it. But this is where the experience comes in. I was saying earlier about investors having the right experience to help the portfolio company. This is an important part of experience that needs to be taken into account when entrepreneurs think about where to take money from.
It's speaking of advisory, I was having a look at who's on your board, and I saw my good old friend there, Steve Blank, is on your board too. He's been on my show a few times, and I love your answer. because I think it's the right way to do it. I wouldn't want to. I would ask that question anyway. I think if I was approaching a venture capital firm and saying, "Hey, look, I need a couple bar to help me do X," I'd want to know, what am I in for? Because one of the things I'm just cognizant of is, I saw some stat. I can't remember where I saw it, but it was obviously, if you see it, it's real, right? But it was like one in two founders, if they raise VC money, are replaced by the board of that firm. I think it's like within 36 months or something like that. It's a high number, and it's because of the quote unquote circumstances, isn't it, around that? Like yesterday, I was chatting to another founder, and she was replaced. And it's like you're done. So to get in bed with someone like that, if you don't know how they would approach a certain scenario, it's important to ask the question, isn't it?
Well, but I would say the following, because I've been a founder. Not every founder replacement from, let's say, the CEO position, which is typically where the replacement takes place, to some other position within the firm should be difficult or bad. Okay, it always depends how it is handled, and I'm very much aware, because I've lived through it, that ego plays an important role. Vision plays an important role. There are a bunch of other factors that come into it. But we've also seen, both in our own portfolio and in in portfolio of other firms, that if a transition, not a replacement, but if a transition happens in the right way, it can greatly benefit the company and also benefit the person that is transitioning from one role to another. I've worked with a few entrepreneurs on multiple startups, and I'm very upfront with entrepreneurs. I don't know, sometimes they don't like that, but that's who I am. I would say to them, you can provide a lot more value given the state where you have brought the company by playing this other role and not necessarily being the CEO, right? And some entrepreneurs get it quicker than others. Some don't get it at all. And that's, but I would say not every transition has to be dramatic.
I agree with you. It's all about how you approach it, right? And you are dealing with people. It's not just a ledger. But
exactly. But this is why what we were saying before, that understanding where the founding team is coming from before you even invest in them, right? And understanding how they complement each other, how they support each other, what is their output, what they want to achieve with this company that they're asking you money for. Those are important considerations. And a lot of times we get the signals directly, and a lot of times we get them indirectly by just observing their behaviors.
Agree. I want to change gears, Evangelos, and ask you a question around sleep. So what keeps you up at night currently when it comes to the world of venture capital? For instance, is it raising a fund from LPs some point in the future? Is it getting appropriate DPI or carry? Is it something else?
So these days there are two things that keep me up at night, to be honest with you. The first one is the portfolio. Okay, the portfolio, because of everything that we talked about today. There is investors are pulling back on their investment appetite. Corporations, which are the principal clients of our portfolio companies, are pulling back from investments in new things. So the capital needs of our portfolio and the health of the portfolio is most of the times when I wake up, and I'm not saying this because you asked the question, but a lot of times I wake up at 3 a.m. and I say, okay, what is going to happen with this company? Should I talk to the blah, blah, blah? Okay. So that's point number one. Point number two is really what our own corporates, what signals our corporate partners are sending, right? In terms of how are they going to approach their over-the-horizon investments, right? Because again, when we fund startups, the solutions that they provide are for important problems that don't need a solution absolutely in the next day, but they need solution, but they also know that it's going to take some time for that startup to provide that solution, right? So there's an horizon issue. So understanding where how our corporates approach the current macro environment is something that also keeps me up at night, because we have seen in the last few months corporations really scaling back some of their initiatives for which they were looking startups to provide the answer, let's call it. So that is definitely that is also, as I said, another issue that keeps me up at night.
Perfect. Well, not perfect. It's a horrible thing. But that's why you do it, dude. It's like your problems today will still be your problems tomorrow. But I'm very empathetic. Like I had the worst night's sleep because of my kids last night. One was throwing up and then the other one set the other one off. And then it's like, anyway, and then 5 hours of podcasting today. Worst day ever to have that kind of start. But anyway.
I hope it goes better over the weekend.
Yeah, well, me too. So looking forward, Evangelos, how do you see the world of venture capital evolving in, say, the next 5 to 10 years, if at all?
So my first company, the first company I started was 1991, and there were very few VCs at that time in the United States, and today there are thousands, okay, including corporate venture capital firms as well as institutional, and you have angels and super angels. So there are a number of different investors that are converging that have converged in the same market. So I believe there is going to be some sort of a clearing out of this as we go into maybe more normal times. It doesn't have to be recessionary, but definitely slower times. There will be firms that do not raise another fund. There will be firms that call it quits because they find it too difficult, whatever the case may be, because their partners decide to do something else with their lives. So I believe that there's going to be a transition just because of that. Now, I also believe that the role of the VC is just a money source, capital source, will go away. You will need to be able to show to the entrepreneur what value you're bringing on top of capital. And it could be technology, it could be technology understanding, it could be experience in negotiations, but it has to be some competencies beyond I have a pool of capital and maybe I have some connections. Because in today's hyper-connected world, getting to certain connections is no longer the asset that it used to be back in the 90s when I was doing my startups, right? today it's much more important to be able to come with something special, right? That special, as I said, could be your understanding of the market, it can be your technology knowledge, it can be your focus in an area, and because of that focus, you understand that area like nobody else, or very few people. But I think that's what is going to start separating the, especially on the early stage, the good investors from the run-of-the-mill investors. You will also have the other thing, by the way, that we're seeing, which I have not seen before, but we're starting to see now with some funds, is that, again, I'm talking about, is that you're starting to see some venture firms take multiple asset classes at the same time. So you're going to do both venture and some private equity and some investments in public markets and international investing. So almost like they're becoming a complete market basket of investment alternatives, right? I don't think that many firms will be able to do that, but there are some firms, whether it is Sequoia, whether it is Andreessen Horowitz, NEA, that are starting to behave like that. And I think that's a new trend, okay? That will put them into certain competition also with the large private equity firms, right? The Apax of the world or the Carlyle of the world, right? But I think that's also something that we will see more clarity of over the next 3-4 years.
Very interesting. Evangelos, one more question. I'm going to give you the keys to the Matt Brown Show time machine. And I'd love for you to go back to yourself on day one of this whole investing journey that you've been on. What advice would you give yourself on day one about investing as a VC, private capital, private placement investing?
If I was less of a masochist, I would stay a lot more with venture growth as opposed to investing in early stage. Early stage investing is really, it's exhilarating, my words, okay, but it's mighty hard, right? So I would definitely look at that. But the other thing is, I would also be paying a lot more attention to my co-investment partners. I always think of Michael Jordan's career. When he first joined the Chicago Bulls, he could score 50 points a game, but they would still lose the game. And it's only when they brought around him Scottie Pippen and Steve Kerr and a few others whose name I can't recall right now, that Rodman, right? That they started really doing exceedingly well as a team and getting one ring after the other. Of course, having the right coach also helped, and Phil Jackson also helped tremendously. I don't want to take it. But again, my point is that the reason I'm bringing this analogy is because sometimes VCs may feel extremely strong on their own capabilities as an individual, but it's a team sport. When you work with a startup, everybody needs to pull together. Same thing I was telling you about the founding team, but that extends to the investment team as well. So I would have wanted a lot more Scottie Pippens and Dennis Rodmans and Steve Kerrs around me than thinking that I'm always the Michael Jordan.
Yeah,
which I was not, but I've still thought about it.
That's a really great point to end on. Well, look, Evangelos, thank you so much for being here, man. I think you're doing amazing things, and I've certainly learned a lot from you today. So thank you for being here. It's been a privilege having you on the Matt Brown Show.
Thank you very much. Thank you.
Cheers, everyone. Bye.